Hello, and welcome to Fitch's next installment of its virtual investor series. My name is Euan Gatfield. I head up Fitch's EMEA CMBS ratings division, and I'm here today with my counterpart in North America, Huxley Somerville. Thanks, Huxley, for joining us today. We plan to have a discussion about commercial real estate and the impact of the pandemic on both sides of the Atlantic. What I can see is some clear winners and losers, but also a fair bit of uncertainty, especially over the fortunes of office space. The future of work debate rages on, and few doubt there will be fewer days spent at headquarters going forward. How do you see this playing out in your key office markets?
Yes, so I think it's fair to say that over the last 4 months or so, there's been a consolidation and thinking that probably heading towards a 1 or a 2 day work from home model. There does seem to have been a recent bias towards getting employees back into offices, and perhaps properties in regional cities may have in the future more of a traditional office environment against those offices in cities with strong reliance on public transportation or long commute times. And New York City, Chicago, San Francisco kind of spring to mind there. However, because of the staggered lease profile and the often strong financial condition of the tenants, we believe that this is only going to play out over the next 3 to 5 years. We're already seeing a substantial amount of sublet space, and that's going to weigh heavily on the market. But we really haven't got a clear idea, and I don't think tenants have a clear idea of how they're going to utilize their space as it comes due. We have seen anecdotally where leases have come due in the last 12 months that tenants are extending for 3-5 years, which provides them with a little bit more flexibility to see how the rest of the market may play out. Certainly, I think we're not seeing a lot of renewals for 10-year space right now. So we believe that if it's a 2-day work from home model, it's going to lead to a reduction in rents and a potential for increased vacancy, depending how landlords might decide to operate their buildings. They can basically choose between holding firm on rents and tolerating vacancy, which is probably what I would expect them to do early on, at least, or reduce rents and maximize occupancy. And at least early on, that may be less likely until they also get a clearer view on what the office space market's going to look like. But obviously, that's also going to affect their bottom line as far as being able to recover expenses from the tenants. If it's vacant, they can't recover expenses.
Yeah, no, I think that's an interesting point, Huxley, from a UK perspective, because we're grappling with very similar issues. One of the difficulties of vacancy is the non-recoverable expenses, and in the UK we have business rates which can amount to a significant liability for landlords to the exchequer, to tax obligations, and we think that is a meaningful deterrent against what otherwise might be a nice option to keep space vacant. And actually, we think that probably we will see some greater use of tenant incentives. We're already starting to see longer rent-free periods, for instance, where still those kind of costs pass back to the tenant.
Yes, definitely. Tenants still do hold the whip hand here. They're not going to be, they're going to do what they feel is the best for them, and the landlords are going to have to react whatever way that works.
Yeah, I mean, so that's an interesting way of looking at it. That tenants hold the whip hand. One thing that we've been discussing here is a little bit about how perhaps we got used to viewing offices as a utility for financial services, information, knowledge economy tenants out there, and maybe it's moving more towards a luxury, with less compulsion, I guess, for tenants to aggressively bid for space sort of in advance of their growth plans, or to lock in security of tenure, knowing that they've been able to cope really rather well with remote working.
Yeah, that's a good point. I mean, certainly we expect that there's going to be a bifurcation in performance, and it's going to be based on various metrics. The top A-class properties and lower quality B and C properties, recent construction versus older buildings. Although some of that, most recent build offices are also the top A-quality properties, especially in New York City. And then one interesting area that we've been looking at is areas close to mainline transit terminuses, so Grand Central, Penn Station, where offices around those don't require the need to get on the subway after the train. And of course, with Grand Central, not only does it serve Westchester and Connecticut, but shortly we'll also have the Long Island Railroad coming in. So I think that's going to help enormously for office areas around there. Of course, the people making the decision where to rent are the CEOs and the CFOs who live at the other end of the lines there. The general workers are going to be coming from all over the tri-state area. So it certainly helps those in higher management, perhaps not those lower down the pecking order. We've seen ESG concerns. Strong buildings with strong environmental qualities, I think, will perform better than those without. And then office buildings that have, they're not just straight offices with restaurants and retail and other amusements will also perform better than they're just a straight office building. And then the kind of quality of the overall space, is the ability to be flexible with meeting areas and work areas, fun areas, or is it just an office with cubicles and perimeter office, which perhaps, again, may be self-selecting because they might be older office buildings, but more difficult to provide flexibility to what the tenant may need, and what the tenant may need is changed over time as we start to see how the work from home environment is going to play out.
Yeah, that all chimes with what we're thinking here in the UK as well. A floor plate size, I think, might be an interesting one, because it strikes me that larger floor plates do give greater degrees of freedom, to reconfigure space and build in that flexibility, which we hear again and again is going to be a real driver. There's also something, I guess, we think, will building height be another way in which tenants might discriminate because of the well-publicized challenges associated with getting people up through the bottleneck of the lifts in the very high rises.
Yes, I mean, that's something that we kind of thought about we published an office stress test back in March that focused on single asset, single properties. A large number of them are New York office. And we had two stresses, a moderate and a severe stress, based on 2 and 1.5 and 3 days work from home. Certainly, because it's a stress test, there's an immediate effect on rent, occupancy, cash flow, values, and ultimately the ratings where they can go to. But each individual office has to be looked at on its own merits, and certainly market rents back in 2019 are not the average rents in a property that's rated. They're on average, they're 10-year leases. So on average, theoretically, it's probably around about 5 years back is the average rent. So depending on the rent roll, etc., the effects are going to be very different as it plays out over time. We're currently working on a similar stress report that applies similar stresses to offices in multi-borrower deals, which are laid on top of stresses we've already been applying in surveillance on the 3 properties that we immediately thought would be most affected by the pandemic, which are retail, hotels, and multifamily. And we expect to publish that in the next couple of weeks. But generally, I think Class C is going to be the most affected, and alternate uses are going to need to be found for those. Class B will be affected depending on the location and its tenant mix. But Class A should be the least affected, though we do recognise that rents and vacancy will be weaker than they had been pre-pandemic.
Yes, yeah, that seems, I think, a fair summary of the consensus I think that's emerging. Thank you for joining us. If you do have any questions on the topics we've discussed here, please send an email to the address on the screen. Thank you.
Thanks, Euan.